Yahoo Finance is on the ground at the World Economic Forum in Davos, Switzerland, and lots of focus on the incoming Trump administration, what that may mean for markets, what they might mean for the world's biggest banks. Speaking of banks, we're here with Bank of America Chair and CEO Brian Moynihan. Brian, good to see you.
Good to be here again.
No jacket as always.
No jacket. It's nighttime. It's a little cooler out here tonight, but it's fine.
Fair enough. So President Trump, newly inaugurated, promising this will be a new era of prosperity for the country. Are you on board with that?
Well, I think in the end of the day, if you speak from the business community, which largely, we have thousands and thousands and millions of business clients, I think they believe there's an opportunity here that the tax regime will stay in place, which is an advantage in the United States, that the regulatory environment will move back to the center, and that the opportunities off of that, because the President of the United States, are high, and I think that's given enthusiasm. And that to me is, from the business side, that's the major part of this message, which is less regulation, tax regime stable, investments in America, and for mid-sized companies and small companies in America, that's great news.
I remember you telling me at our Invest conference in November, you were concerned about deficits and how they've ballooned. Can the administration push through tax cuts and what it wants to do, given where deficits are?
I think the tax cuts will be hard because where do you find the revenue to cover them? But maintaining tax rates, it's going to take some spending reduction. It's going to take some views on how they spend money, where they spend money. It's going to take some, hopefully some more growth to grow your way out of a little bit. It's going to take, and the predicted growth is higher, and it's going to take other activities. But backing up, I think the incoming Treasury Secretary in his hearing made it clear, we've got to get this debt balanced out. It doesn't have to go down, it just has to flatten out against the growth of the economy. And I think having a strong economy is the backbone of that, and then getting people to invest and create even more jobs and more growth is the backbone of that. But we've got to be careful. We've got to get this a little bit more rational, and that's, to me, that's one of the biggest issues the America faces alone. There's worldwide issues, wars, this, that, but the one America faces alone is to get the debt back in line just a bit, and that's going to take some disciplined spending.
You think that's what we're seeing? I look at what's happening in the with the 10-year yield, close to 5%. A competitor bank, Nomura, calling for 6%. Do you think that's the early warning signal that these deficits have to be brought under control?
Well, I think this is where, Brian, you have to get away from the trading question to the long-term question. We were at this level, 6 months ago, whatever it was, and it's back to this level, and when the 3%, a 4.5% Fed funds rate, you expect the 10-year to be higher because that'd be the natural shape of the curve. If you go back and look pre-financial crisis, 70-odd% of the days, the 10-year traded between 4 and 5 or something like that. This is more of a normal rate environment, which frankly, with all the work that's gone on and all the post-financial crisis, to have a great financial services system, to have a real interest rate environment, to have inflation be higher and bringing it down, as opposed to for 15 years we couldn't get inflation up. It's actually a good place to be, to have a little more robust economy, going back to the debt question, because the inflation makes the debt smaller if you don't issue a lot more of it. The second thing is it's more normal. And so I think we got to be careful about overreading it. So I think, yes, there's momentary trading days where people, oh my gosh, they're going to be issuing a lot of debt, let me back off or let me come in. But at the end of the day, I think it'll fundamentally settle in a range. Our team has a predicted in this 4.5% or so plus or minus range, and has the Fed funds ultimately getting down to basically 50 basis points lower it is today at most, and that's kind of a real rate structure.
Hang with me on this. I'm going to try to tie some dots together. Should we get tariffs? That might lead to inflation. Do you think the Fed's next move is a rate hike? There's been some chatter about that on the ground here in the early going.
Well, I think it's few hours old, so nobody really knows what the potential tariff question is. Our team, our research team, and Candace Browning Platt and the team looked at the discussion around tariffs and came to the conclusion that 10-15% doesn't think has a big impact the economy or inflation. You start rising above that, it gets a little more interesting, and then it becomes very specific as to where. And so most of that will be passed through, and the customers will absorb it, and there'll be more wage demands, and it'll kind of work. And so it could be inflationary, but I think in the nominal levels they're talking about widespread, less possibility of that than if it were higher across everything. If it's focused, that again doesn't have as broad effect. But I think this is the question that the Fed has to think about: is they've got a new administration with a new set of fiscal policies, and the monetary policy has to respond to that. We are not a central bank-led economy. We're actually a private sector-led economy, of which the government supports, of which the central bank responds to, and they have to think of what stimulus they're going to, what data they're going to respond to. And you're hearing that chatter go back and forth. I think on the other side, consumers are spending at a a level in our business which is consistent with a 2% inflation, 2% growth economy. So we've got to be a little careful that we don't dispirit the consumer with high rates, especially on the front end, especially the small business and mid-sized companies, because they pay the higher rates. Large companies go to the market, get out the curve, and frankly, other than mortgages, the impact of the rates on the general consumer borrowing is relatively minor. It's cars and mortgage, the two places you feel it, and half the mortgage, and most of the mortgage holders are locked in at a far rate lower, and that if they have to move or something, that's a different question.
Bank stocks have been really on a tear since the election. We leave one of the largest banks in the world. What could this administration do in terms of regulation to justify the moves we've seen in financials? What do you want to see from the Trump administration?
Well, we in the industry have been clear with the Biden administration, the old Trump administration, and the Biden administration. We want a highly strong capitalized, strong liquid set of institutions in this country, because it is one of the reasons why America has success. Is it has a great financial services sector, a great capital markets, a great banking sector, serving people well, growing, innovation, the whole 9 yards. So we believe in that. But what happened over the last period of time here is the creep up of all the different factors. And so if you point to any one, you say, well, that's not that much. But when we add them all together, simply put, we have about 25 or 30% more capital to get the same capital ratio 5 years later. Our risk hasn't changed much. Matter of fact, our risk has probably come down. And you're saying, how could that be possible? It's all in the underlying counting and rules. And so people are saying, can we slow that down and put it back in the center? We are the most competitive in the United States of all the financial service industries in the world. So the idea of it making us competitive isn't the problem. The idea of it keeping us competitive, we got to be careful of. But why shouldn't we be the best? Why shouldn't we lead? Why shouldn't we help drive the world's growth through the major institutions in the United States? Because that's good for the country. It's an exported industry of high order. So I think what we want to see is capital, a little more rational, and you heard the dialogue on the stress tests and things like that.
So that's like the Basel III.
Basel III and stress tests, the two go side by side, and a bunch of other rules. And then secondly, you want to take a look at some of the liquidity and other rules which got stacked up and actually have an adverse effect on carrying capital, which doesn't make a lot of sense because some of the other tedious things that go on banking regulation. And then you want to look at regulation around consumer activities and keep it balanced, because what you don't want is a company to run it one way, then this way and that way. You really want to run it so the consumers can depend on it, we can depend on the consumers, and have a set of rules and laws that are actually implemented by the people the consumers voted for, Congress, and then the agencies react to that instead of people making up law through agency action.
Lastly, before we let you go, I remember a couple Davoses ago I asked you about the crypto market. And crypto is still emerging, and like it's out there, and I get it. But now things have changed. Yeah. Has that changed your thinking, and will Bank of America be more aggressive on the crypto front, given what looks to be a friendly Trump administration on this issue?
It kind of depends on what you mean by crypto, right? And so the blockchain technology, we've got a lot of patents on it. Then there's a stable coin type of currency, digital currency, and then there's the investment management type of currency. And I think the first one and the second one, yes. The third one's hard because that's really an investment question and how it works. But the issue has been for the last 10 years, as this has been talked about, is the enabling legislation was never there for the mainstream financial institutions to participate. So not only do we have issues with supporting clients in the business, but we couldn't really transact it because of AML and BSA issues and all that stuff, and also sort of where the money is and who's holding it. So I think if you see enabling legislation, I think you're going to see our industry come at this hard. It's just another form of payment backed by dollars and treasuries and things like that in a stable environment. We'll come after it. It's if you think about it, I go to here in Switzerland to a small village and I hand them a credit card and I get dinner. If I could pay them with a stable currency and get dinner, I wouldn't care if I was a consumer. And so I think that methodology will become a part of core banking. We already send that. We don't need a digital currency bank. We already have $3 trillion will go out in digital money over. Not today's a holiday, but tomorrow. And that's what we do. So it's not new to send digital currency. This will give you another mechanism which may allow cross-border transactions or people traveling and transactions or buying earrings and small balances through e-commerce and stuff, maybe travel a little bit here with a little less tariff. That could be good, but it has to be stable coins. It has to be backed by something that we understand. It's hard in the investment area we'll leave that to people to make their own choice.
Fair enough. All right, Bank of America Chair and CEO Brian Moynihan, always good to see you. Go back and get a jacket. Let's get you out of here. Come on.
It's warm out tonight. It's 5-10 degrees above normal.
All right, Brian, always good to see you. Appreciate it.
Good to see you.
All right, thank you.
Thanks.